In this video, we'll take a look at slippage in forex and what we can do to keep it from happening. Slippage is a term that refers to be filled at a price that is not what you expected. So let's say you're trying to trade this market here, the euro dollar at 110.05, but you actually get filled at 109.90. That's a 15 pip difference. Most of the time you see something like this happen, it happens around news events. It's because a lot of traders are jumping in and out of the market. It's not anything nefarious. You need to be aware that there are times when the market is more liquid than not. So like illiquidity means there's a lack of orders, while liquid means there's plenty of them. You can get in and out of the market pretty quick. Unfortunately, most retail traders start to hear stories about all of the money that can be made trading news events. While this isn't completely untrue, trading while an event is going on is akin to gambling. So here's an example. Let's just say that you think that non-farm payroll numbers in the United States, one of the biggest announcements for the month, are expected to come out a gain of 250,000 jobs for last month. You believe that the consensus is what most market participants are expecting. There is a surprise in the announcement, as the United States has gained only 125,000 jobs for the month, which would be a huge miss. This drives money away from the US dollar, and you decide to short the US dollar by buying the euro, which is a reasonable thought process. But at this moment, there's several things going on. The biggest mistake that you are doing here is that you believe you can react quickly enough to information that is highly automated by high-frequency trading shops. So by the time you have pressed the button, say you click on this and you go to trading and you want to click new order and you pull all of this up, most high-frequency traders will have been in and out of this market multiple times. Furthermore, there aren't that many in the market to begin with. So what happens is, on the surprise announcement, let's say, and I'm going to use small numbers just to make the point, but let's say 20 traders decide they want to jump in at this price, but there's only 2 at this specific price. And then there's 3 up here, and so on. So what's going to happen is, so now you have 18 left, and these guys, if they pressed market orders, then it's 15, and then it's 14. Well, notice how price keeps going up to fill that order. You have to have a seller in order to buy, or vice versa. When you click on new order, market execution, it's a market order. It means that you're wanting to buy at the market. This is the price being offered. The market's closed, so the spread's a little high, obviously. But you click on the buy by market, and that means that your broker's going to fill you at the best available price. And in a time frame like that, when so much is going on, the best available price might be 10, 12, 15 ticks away from where you are, even in the euro dollar. But keep in mind that the pair matters. The liquidity of a currency pair has a lot to do with whether or not you will see slippage as well. It's not just the time of day. A highly traded pair like the euro dollar, attracts a lot of order flow. So it's basically around major events that you have to worry about this. However, if you're trading like dollar Mexico, well, dollar Mexico is a lot less liquid. It is a wide spread, and you have to worry about the time of day that you're trading. That has a lot to do with it. Although the daily candles won't reflect it, if you drill down to 15-minute candles, you will see certain times of the day it's a little bit more impressive as far as the moves, and that's because it's primarily traded in North America. If you get some type of a news announcement around a pair like this, then it can really jump. You can be talking a couple hundred pips. So what's the solution? The solution is actually rather simple. It's just when you place a trade, you click on trading, you click on new order, and I'm using the MetaTrader platform, obviously. You go to pending order, and then buy limit. or sell limit. So a limit order says that you are going to request a specific price. And if it gets skipped in a matter of slippage, for example, it just doesn't get filled. You are only willing to pay, let's say there's a buy limit here, and you want 110.97. You're willing to buy it there. You click on place, and it will not fill. If 97 for whatever reason gets skipped, and say it just jumps up to 99 and keeps going, it won't fill you. What if it jumps to 98 and jumps back down to 96? You're still not filled. It has to fill at this specific price, or you can even get more granular. If you do limit orders, that means that the market you will only get filled if that price is offered. If it's not offered, it doesn't matter. It's a lot different than a market order. Market order, you're just wanting to buy at the best available price. Pending order, you can also see their stops, like a sell stop. So say you're long of the market. If it reaches a certain price, say 109.80, it places a stop. But this is a market order. So in other words, if it goes crashing through there, you might get a little bit of slippage here. Say you get filled at 109.77. Well, that's a lot better than letting the market go against you. Granted, with most pairs, like the euro dollar, 99.9% of the time you're going to get filled at the price you request, unless you're messing around with non-farm payrolls. This is non-farm payrolls here over the course of an hour, and you can see just how crazy that got. So something to keep in the back of your mind. Use limit orders, and you can eliminate the entire problem of slippage.